All right, everybody. Hello, hello, hello. It is, wow, we are March 11th already. So welcome to Money Matters. I am Hong Lu with Cash Property Inc. And today, over the next 30 minutes or so,
All right. Hello, hello,
oh,
hello.
let me turn this off. Okay. So we are going to continue the analysis on the North Shore Bike Park. Yeah, so we'll definitely go through that. And then I've got a question that came through from one of my last broadcasts. So I'm glad to go back and answer the questions that came through on that. Yeah, and the bike park one, that was it's something that I love doing because it's a place that we go to quite often, and it's a really interesting strategy that somebody, did with real estate and repurposing, reusing space that was not used for anything anymore. So it was really creative. So over the next 30 minutes, we will be doing that analysis and answering the question. So before you go and take any of the content that I put out there today, please go and check with somebody else because it may not be the right thing for you, right? Like the outcome of these presentations are really to help fellow accredited investors make sound decisions, give you some ideas as to how to grow your net worth, how to grow your family office, what other opportunities there are out there. So please, please, please. Yeah, just check the information before you go do anything with it. Okay, so before we go into the analysis, I wanted to share a company that I came across recently. And this is really interesting because I grew up in so my parents had a variety store. And one of the things that we always did on the weekends was go to a wholesaler to buy groceries, right? And I stumbled across this company called CHW Floor Wholesale. And I'm like, oh, this takes me back to the days of when I, used to have to go to wholesalers to buy groceries for a variety store. So even though the name says wholesale in it, it's not just for contractors, it's not just for wholesaling. If you are doing your own renovations at your home or if you're working with a contractor, you can go to this company and get good quality flooring at very good prices. Okay. And the reason why I'm bringing this up is because in real estate, we're constantly looking at ways to cut our expenses, improve the quality of the product that we're renting out to our tenants, our clients. And flooring is one of those items where you need to put in the time to make sure that you're putting in a decent product because you don't want to be changing out the flooring every time you get a new tenant in there. Okay, so flooring is one of those items where you put it in and you hope you never have to worry about it for several tenants because it's very disruptive. One, because you need the time to install it. Like all the furniture needs to go, and it's not just the flooring, it's the trimming around the flooring, it's the underlaying on the flooring as well, the soundproofing. There's a lot that goes into flooring. Okay. So you don't want to nickel and dime on this, and you don't want to be like, hey, let's just go to this other store and just pick something random. Okay. So this company here, it's family run. It's been in business for over 20 years. It's in Burnaby, BC. So you sort of have to be in BC around Burnaby to take advantage of this company. But the reason why um, I want to, hone in on this company is because the flooring, once you have the right flooring, you can just then worry about getting the right tenants in there, and then you don't have to worry about the flooring again. Okay, so the other reason that I really like, to go with wholesaling companies, one, because the product's cheaper or usually cheaper, you get better quality. This family that owns it, they've been in business for 20 years. So imagine the knowledge that goes in there. Okay. The other reason why I like this company is because you're not paying for a fancy showroom. You're not paying for talking salespeople to come at you. Okay. What you're doing is you're paying for product. You're paying for the service that goes with the product, the knowledge that goes with the product. Okay. So you're not paying for a fancy, shiny showroom. Okay, so this company CHW Floor. So the W stands for wholesale. Okay, and the CH is the name of the owner. So it's Chan wholesale. So that's how you can remember it. Okay. So CHW. Okay. So that is a recent company that I came across and happy to help local businesses grow. So, all right. So not just for wholesalers, not just for contractors, but also for um, uh, DIYs and people who are hiring contractors to do their primary places or multifamilies. All right. So let me get out of this because I want to get into the calculations. As you know, being from an engineering background, I love calculations. All right, so let's go into the that biking, that BMXing. All right. So where is my Excel sheet? All right. So here we go. So this came about from our last week session. So if you did not catch the last week session, it is live stream on YouTube and also on Facebook. So you can go back and check it to see how I built out this initial spreadsheet. Like we started from scratch on this spreadsheet. Okay. And so there's a few more things that I just want to point out here. Keep in mind, so last week was about 30 minutes. This week, maybe another 20 minutes. Okay. Once you get the hang of this analysis really should take about 10 minutes at the most, right? Like you want to do it on the back of a napkin to be like, hey, you know what? Is this business idea worth pursuing? Okay, so let's jump right into this. So we are doing this on a bike park as an example. So this you can apply to any type of business. So at this point, we're talking about just the business only. And then I'm going to tack on another option where is the business plus land. Okay. And that's what I'm getting into now is looking at business opportunities plus the land. It's part of the McDonald's strategy, right? Like what business is McDonald's in? It's not burgers, okay, or their amazing French fries or chicken nuggets, okay? It's the real estate that goes with that business, okay? So we'll tack on that after we just go through this analysis on the business only. Okay, so in this example, we're saying, hey, the income on this business is about 38,000 a year, and we barely put in all of the streams of income that's possible with this bike park. Okay, so now the expenses, we're just very roughly saying, hey, the expenses are about 30,000. And so this is, did we go by year? Monthly. Okay, so we went monthly here. Okay, so that means each month we're going to be almost making $8,000 in net income, which is really great. Okay, so for the year, we're saying about 94,000. Okay, we used a multiplier of 10. So when you are doing your research, you're going to know what this multiplier is. Okay, so I just usually go on Google and I type in the industry that I'm looking at, and you can get a good range on that multiplier. Okay, so the true value of this business is roughly about $945,000. Okay, so when I think last week when we said, you know, that we're going to assume an asking price here of $100,000, that was really, really low because if this multiplier is 10 and the business is worth about $1 million, you know, we're going to be paying close to that million. Okay, unless you can negotiate some other stuff. Okay, so I updated this to have a $2 million price tag. I'm going to go back and put 1 million in here. Okay, just so that you could see what's going on. So let's just say that our initial capital in is 500,000. Okay, now this is on the lower end because usually for a business, you need like 40, 50% of the purchase price to go in. And then you also need, you know, potentially to have financing from potential investors and so forth like that. So in this example, we're just going to say that we've got 500 cash, whether it's our own money or from investors. Okay, just to show how the numbers are going to work. But keep in mind that your down payment or the amount of money that you need to put in is usually going to be around 50%. Okay, so so the number that is in here is just an input number. Okay, and then the cash on cash return. So this is how much of your initial investment you're going to get back in the first year. Okay, and potentially it's going to be every single year after that. So in this case, we're saying about 18.9%. So the math behind this is what is the net income? Okay, so the net income. So it's all the expenses, less expenses, divided by your capital in. Okay. Now it's interesting to note here that your net income at this point does not include any debt servicing. So any mortgage, any private money that's coming in that you have to pay debt on, it doesn't include any of that. Your NOI, your net income, is always just income minus expenses, not including your debt servicing. So in this case, our cash on cash return is going to be 18.9%, which is a really good number. So the way to use this number is saying, okay, well, how many years is it going to take me to get back the initial 500,000 that I put in? Okay. So in this case, it's going to be about 5.3 years. Okay. So when you do these analysis, you'll come up with a consistent number all the time. And so you'll know, hey, is 5 years good? Because maybe on some of your other opportunities, you're seeing this back in 3 years. Okay. A lot of times I would like the money back sooner rather than later. So if I can get this back in 1 year, 2 years, 3 years, that's way better than getting it in like 7 years or 8 years or 9 years. Okay. So this is another way to look at your numbers. So the net income per year is fantastic, but when you look at it in, hey, how fast will I get that money back? Okay, and the reason for that is because the sooner you get back your capital in, whatever amount of money you had to put in, you can go and deploy it on something else, right? You're diversifying where your money's going, okay, and you're not locked in as for a longer term. Okay, so that's my logic around that. Okay, so now let's throw in, I want to make sure that we catch all the prices here. Okay, so the other thing to keep in mind here is that there's no debt servicing on here, okay? And there's no owner's salary in here. So we do have like a manager fee, okay? So if you're planning on working in this company, you're going to want to pay yourself. Like you're not trading your time for another job. Like you're not going to leave your full-time employment, like your 9 to 5, to work at this company and not get paid. Like the whole point is you want time freedom back. You want to make at least double what you're making in your 9 to 5. Okay. So for myself, like as a retired engineer, I'm always thinking, okay, well, when I was an engineer, I was making 6 figures. If I buy this company, am I going to make 6 figures? Am I going to be able to leverage this company to make 6 figures some other way? Okay. So, and especially if I have to put time in, I want to make sure that every hour that I'm working on this company, I'm making more than what I would make as a working at my engineering 9 to 5 job. If I'm working at this company and I'm not making as much as what I would be making as a 9 to 5 job, why am I doing this? Like the whole point of this is to have time freedom, right? So, all right, so that's the one thing to consider as well, is that this manager price, this manager salary here may come back to me, but ideally it's going to go to somebody else. Okay. You may want another line item here, which would be seller's discretionary income. So I'm going to just type that over here so you could see it. So it's SDE. Okay, seller's discretionary income. This is usually a line item that's included, and when you're doing your calculations, you may want to leave that in or you may want to take that out. Okay, so you definitely want to make sure that you have some consideration around this. Okay, what else do I want to say about this? Okay, so let's go into now running this scenario as if we're buying this with land. Okay, if you're buying, so this North Shore, you can't buy the land. Like it's in a mall and it's an existing plaza with other businesses and stuff. And to buy the land, you're looking at a lot of money. Like it's not cheap. Okay, so, so let's just say you're buying this business, but you're then going to go and buy the land that comes with it, which is another opportunity. So then this asking price is going to be for the land plus the business. So you're going to run two scenarios on this, right? Plus the land. So I'm just going to go in here and tack on what maybe the land value is going to be. So let's just say their asking price is 2 million. So we're assuming that we're going to pay the full price, okay, until we run the analysis, and then that's when we negotiate on the pricing. So let's just say that the land is worth about $1 million. Okay, so this is an input value. This is a number that you would want to get from your real estate agent, pull it from comps, pull it from the assessments, like your MPAC reports. So there's ways to find out what the land value is. Okay, so now this land value is as of today. Okay, now depending on where this opportunity is, there's going to be appreciation. Okay, yeah, hopefully there's land appreciation. Okay, but we're not going to consider land appreciation in this calculation. We're just looking at today's prices as of like a stagnant number. Okay, so we're going to put in a million. And then what we're calculating now is the total value of this opportunity. So really what it is, it's your business multiplier number, which is this $945,000 plus the value of the land. So we get not 1.945 as the total value of this. So you could adjust your purchase price for 1.95, or you could just, go with their asking price, right? So this is fairly close to what they're asking for. Okay. So this is one way to do a very quick calculation to know whether or not their asking price of 2 million is a decent number. Like if they're asking for 1.5 million and you calculate this and the total value is 1.9, well then you're getting a steal, right? Okay. So on that note, you want to make sure that you know your market, right? So that's part of knowing this land value, knowing, you know, is the population going down? Is the population going up? What's the employment there? What other industries are there? So that's part of knowing the market, knowing the industry. So the fundamentals of running your analysis and doing your market analysis before you get into a market is still super, super important, even though you're just now buying a business plus land as opposed to like a multifamily. Okay, so a lot of the same criteria still apply. Okay, so now let's go in and take another look at how to structure the capital in. Okay, so that's on this tab here. So let's just say that in this particular case, we need to raise $500,000, whether it's our own money from a line of credit or from investors. There's so many ways to bring in this money. Okay, so now let me go back here because I want to calculate what that number would be in terms of capital in. So it's capital in divided by your offer price. Okay, it's not what they're asking for, it's what you end up offering and what the final purchase price is going to be. Okay, so in this case we've got 25%. Okay, so the number that was calculated there is the amount going in, okay, the amount that we're investing divided by the offer price. So 25%. So that is on the low end. If you're able to do 25%, you're probably going to have like a vendor take back where the uh, the current owner is going to help you finance significantly. So then that way you don't have to go to the bank. So you can negotiate this VTB, this 25%. So most likely we're going to need closer to $1 million going in. Okay, partly because that is the requirement from lending institutions now. Okay, so now this amount is because it's got land in it, right? If this was just the business, then you're not going to be paying 2 million. You're probably going to be paying about 1 million in this case. Okay, so keep in mind that the capital in is to cover the land value. Okay, so we're sort of moving into the next scenario of the opportunities that I look at. Okay, so the investment needed is just pulling it from the other sheet of $1 million. Okay, and so now what we're doing is we're calculating if you were to bring in investors, what that structure would look like. Okay, so here I've got two partners in the GP side. So that is the general partner, the working partner. And in this case, I'm using 3 LPs. Okay, I purposely like to keep my number of LPs as low as possible. So in this case, we're running 3. Okay, so as you can see here, we've got 300 from one LP and 100 and 100 from the other 2 LPs. This doesn't get us to the $1 million that we need. Okay, so which is why I've got this number here at these two questions that I always like put in as a check. Has the total amount been raised? Okay, the answer here is an automatic no. It's just a formula in here. If you can't raise the money, you can't close on the deal, or you have to put in more of your own money. Okay, so that's why it's a no here, because we're not at the million yet. We've only got the 500,000. Does the total equity equal 100,000? So the total equity is this column here, which is the percentage put in by everybody. Does that equal 100%? Okay, this is just another way for me to check to make sure that we've accounted for all of the equity splits going to each individual that is in the project. So in this case, we're saying that the GPs are going to have 30% split and the LPs are going to have a 70% split. Okay, it's really just GP plus LP is going to give you 100% all the time. So if the GP has 20%, then that means your LP has 80%. Okay, if the GP has 50, then your LP is going to have 50%. Okay, so in this case, we're at 65%. So the number isn't lining up here. Okay, so let's just say that we have the first LP, okay, which is your partner 3, coming in with 450,000. So we're going to increase this. And the second LP is going to come in with 200,000. And then the third LP is going to come in with 350. Okay, so in this case now, because there's $1 million raised, we've reached the total amount raised of $1 million. So that automatically goes to yes. Does the total equity equal 100? And in this case, it's yes. Okay, so I'm going to go back and just show you the formulas that are behind some of these calculations here. So the GP number is just a percentage put in. So in this case, I'm assuming that the two GPs are equal partners and each one is going to get 50% of their 30%. Okay, so I'm going to say that again. Okay, so the GP gets 30%, but that's an equal split. So each one's going to get 50% of the 30%. So in this case, it's an easy math. So I just go in here and I put in 15 and 15 for each of them. Okay, you could put in more formulas and say, hey, you know what? The GP, one person's going to get like 40% and the other person's going to get 60% of the GP. So there's a different split there. So you could put 10% for one, and then you have to adjust the next GP for the 20%. So in total, the GP is going to get 30. Okay, so you want to make sure that that part of the calculation is correct. Okay, and then the LPs, if you do the sum of those, that's 70%. So you can see that at the bottom, 70%. So the way that the LP calculation works is a formula in here, and we're going to break down this formula. Okay, it's the investment that that individual put in. So these guys put in $450,000 divided by the million. So their percentage of the investment amount that was totally needed. Okay, so we needed $1 million. They put in 450 times the percentage of, in this case, the 70%. Okay, so it's times 1 minus the sum of the 30%. So 1 minus the 30 is going to be the 70. So we're basically saying the percentage that they put in times the 70%, right? Because there's 70% of ownership going to the LPs. Okay, so that number now works out to be 31.5%. Okay, now you might be saying, okay, well, Huong, they put in 450,000 divided by the 1 million, they really should have 45%. Okay, yes, that is correct if you look at it that way. But here's the thing though, they're not getting 100% of the entire opportunity. They're only getting 70% of the opportunity. Okay, so that's what you need to remember. Okay, so, and yeah, so you want to make sure that you do that calculation right. Okay, so let's take this and walk this through on the second partner of the LP. So the second LP puts in 200,000. Okay, so it's the same formula here. You take the 200,000 divided by the 1 million. Okay, times your 70%, because that's all the LPs All three LPs are going to split that 70%. Okay. And because each person is putting in a different amount, it's not an equal percentage ownership at that point. Okay. If each of them put in 333,000, 33, 30, like the 333s, then each one would have equal split of that 70%. But because each one is putting in a different amount, they all get different percentages. Okay. So this person who's putting in 200,000 is getting 14%. And the person putting 350,000 in is going to get 24.5%. Okay. So it's interesting because when you look at this, you could, like, when I go to work with potential investors, I'll say, hey, if you put in 100,000 to three here, okay, so we can see that it's 14% here. So I'll basically tell them, hey, for $100,000 of your investment, you'll get 7% return on your money. Okay. Sorry, you'll get 7% equity in the opportunity. Okay, which means then you'll get 7% of cash flow appreciation, mortgage pay down. So 7% of the opportunity, which then translates to your return. Okay, the interesting thing here is that this 7% is relative. Okay, meaning that if the project, let's say every single year, is making 100,000. Okay, let's use a different number here so that we don't get confused here. Okay, let's just say that we're making 120,000 every single year, and this gets split amongst all the partners. Okay, so this $120,000, okay, translates to how much for this investor here. So 7%. So I'm just going to put my dollar signs in there. So that translates to $8,400 for the investor coming in at 7%. Okay, so if we saw $120,000 in profit every single year, they would get 8,400. Okay, now if this return though, let's say was $500,000, 2, 3, okay, then their return is going to be $35,000. Okay, so when you look at a percentage return, you need to go and say, okay, well, a percentage of what, right? It's not just enough to say 7%. Okay, it's 7% of 500,000. It's 7% of 120,000. Okay, because your return is going to vary depending on what your revenue split is going to be. Okay, so what else do I want to talk about when it comes to this park? Okay, I think that's it. All right, if you have any questions about this, please email me. And yeah, happy to figure out, if there's any challenges with this one, how we can go about it, resolve it later. So this is what I would look at for this opportunity. And based on this, I would be like, okay, so this 10 years, okay, so yeah, because we adjusted the purchase price to go up on this. So this would be to calculate. So even though it took us like an hour to go through this as an example, once you get the hang of this, it should take you like 5 or 10 minutes at the most, right? And then does it make sense to continue with the analysis? Yes or no? Okay, so let me stop sharing here. Okay, I hope you guys found that useful. Now, before I forget, this Friday, yes, this Friday is the third Friday of the month. Is that right? Yeah, this Friday is the third Friday of the month. So we hold our monthly mastermind on the third Friday of every single month. And so if you would like to get invited to the mastermind, please reply to the QR code and we will make sure that you get invited to the monthly mastermind. Okay, it is a 2-hour long session where we talk about real estate, a strategy within real estate, and then any challenges that you're facing is shared with the group. And then as the group, we will help you come up with some ideas on how to resolve that challenge. Okay, so we will move on now to the question that came in. Okay, so this was regarding a a live session that I did in February. So if you missed the February 5th live stream, that was where I shared one of the strategies that I had for, what do you call it? Building out my family office to $100 million. So let me, oh, I did not even open that yet. Okay, so let me bring that up and we will go into the, hmm, okay, so I did not bring in that 500, no, the 100 million. So let me see if I can find that 100 million family office tab. Nope, no idea. Okay, so let me, I may find it another time. So this one had to do with the question around that live broadcast that I did on February the 5th around the $100 million family office. Okay, so one of my goals is to build the family office out to 100 million, which is a big number. And I showed one of the strategies that I was going to use for that um, to get to that 100 million. So in that strategy, I started with a basis of $5 million. Okay. And so the question that came in is, Hong, you already lost me when you said you're starting at $5 million because I don't have $5 million. Okay. So, okay. So this is a very legitimate point, and I do apologize. I was talking about my situation there. And so, for me, I'm thinking in the millions already. So, so the question came is, how do I get to my first 5 million? Okay. And so that is a very good question. So let me share a couple of ideas on how to get to your first 5 million, because getting to like when I got to my first million, it was over many, many years. It was not overnight. Like I got into real estate, second year university. Okay. So keep in mind that a lot of times, a lot of these strategies is slow. Okay. It's not fast. Okay. So if you're able to do this multiple times and do it very quickly, then yes, there's ways to leverage that. And actually, in the monthly mastermind coming up, I am talking about one of the strategies that I'm using to leverage and compound really, really fast. Okay. But when I started out, I was, buying one property and sitting on it, managing it, self-managing for, 2, 3 years, and then buying my next property and then managing that, getting that under control, and then going to the next property. So I was doing it very, very slow. Like when I started out, there was no like major networking groups that I knew of. Like there wasn't that support that I needed. Okay. So one of the things that I would say in terms of getting to your first million or your 2 million or your 5 million is, if you're not up there yet, number one, get support. Like don't figure out how to do this on your own, because here's the thing. If you are not at that stage yet, it means that you really don't know how to do it. Okay. Even if you're a do it yourself, even if you want to do everything on your own, having that support, having the coaching, having the networking group will definitely help you. Okay, so that's the first one. The second one is that there is so much support out there, right? There's so much content out there that you really want to narrow down what strategy within real estate you're going to do. Okay. Not every strategy out there is right for you. Okay. Like, especially, let's say private lending. Not everybody should be doing private lending. Not everybody's in the position to do private lending. Okay. The other thing is, a lot of, so the first one is make sure you network, get the coaching, get the support. The second one is figure out what strategy you want to do and then stick to it. Okay. So part of that may require you to pivot, change strategies. That's absolutely fine. But you want to pick one strategy that's right for you and pursue it. Just focus on that one strategy. The reason for that is that if you're like, okay, well, I'm going to do private lending, I'm going to do flipping, I'm going to do buy and holds, you're spreading yourself way too thin. And it's one of those things where there's so much to know about every single strategy that if you're diversifying that much within real estate, you're not going to become the expert in that field. Like you're not going to be able to leverage and improve on what you're doing. Okay. And then the third one is go and ask people who've done it before you saying, hey, how did you get to that, first million, that second million, that third million? Take their ideas and figure out how it can apply to you. Okay. So one of the things that I always do is when I meet somebody is figure out, okay, how did they get to where they got and how can I use what they've done to springboard off of that so that it doesn't take me years and years and years to figure it out. Okay. There really is so much opportunities out there. Okay. So the other thing I would say is don't worry about FOMO, right? The fear of missing out. And I even have to remind myself of that because I'll look at an opportunity and I'll be like, oh my God, this is such an amazing opportunity. And then I drop everything to like just work on that opportunity. And then I realize, oh, it's not that great. Right. And then I go to the next opportunity and it's like, oh my God, this is another great opportunity. So within real estate, there's tons and tons of opportunities. There's always going to be opportunities. So don't worry about missing out. Don't worry about, oh, well, I missed the 2008 bubble, right? Nuh-uh, right? Be prepared so that when the opportunity comes your way, you'll be in a position to take advantage of it. You'll know that it's a good opportunity. Okay. So the fear of missing out and making sure that you're prepared. Okay. So, there's so much suggestions that I would give you that I can give you on how to get to your first million, get to the next step of your wall. But here's the thing though, at the end of the day, it's action. Okay. Figuring out what's the right action and then taking the steps to do those right actions. Okay. It's not enough just to get the knowledge. It's not enough to just take action. It needs to be the right action to get you to where you want to go. Okay. All right, you guys, I am talked out. Okay. So just a time check. Yeah. So we are in the 30 minutes there. So every Monday. Okay, I am on here. So thank you very much for watching. If you have any questions, please connect with the QR code. And we do have the mastermind session coming up this week. And if you get a chance, please let me know what you think about CHW, okay? The wholesale floor company. Love to hear your opinions on that. Okay, thanks for watching, everybody. Have a great day.